All right, let's talk about housing and home ownership. So, one of the questions that we oftentimes ask is buying a home primarily a financial or non-financial decision? And when we're looking at personal residence, we usually say both, right? It's financial because we have to consider affordability and the long-term benefit on net worth of being a homeowner in that primary residence. But it's also non-financial because there are non-financial benefits associated with that purchase, right? We call that psychic income. I love the neighborhood. I love the control over being able to do with my property whatever I want. I love the school district. Whatever the case may be, those are non-financial benefits. And so the primary residence oftentimes serves both functions. Now, if we're looking at second homes or investment properties, we might answer this question a little bit differently. So, what are some of the questions a client might ask over their lifetime in relation to buying a home? Well, early on in the life cycle, they might ask, is it better to rent right now, or should I be thinking about purchasing a home? And when it's time to purchase the home, what is my affordability? Now, this applies to first-time homes or maybe vacation homes, but I would say that housing affordability is a constant consideration anytime a home purchase is at play. Same thing for the next bullet. Which mortgage is best? Should I be thinking about refinancing? Are there opportunities to advance my financial situation by accessing the equity in my home? Should I be thinking about paying the house off early, right, to reduce the cost of the overall debt and also to free up cash flow for future periods? We talked about home equity already. And then last but certainly not least, how does housing affect my retirement decision? And based on the decisions that I'm making, is this home going to be beneficial to me long term, or is it going to end up costing me more than I might can afford in consideration of my other goals? And then we'll talk about reverse mortgages at the very end. So when does buying a home make sense? Well, we know that there's advantages and disadvantages to buying, right? The advantages to buying, obviously the pride of ownership, right? That's a big thing that people care about. But probably even more common than that, when we talk about advantages, we talk about the ability to build equity, right? If you're shoveling money to something on an ongoing basis for a long period of time, what is the benefit of that? Well, the benefit from being a homeowner is that you build equity in that home, and that equity ends up benefiting the financial situation. There's also a sense of security as a homeowner. And like we talked about before, for clients that itemize deductions, there are tax benefits associated with home ownership. Again, biggest source of itemized deductions, two of them are from home ownership, right? Mortgage interest paid, and then property taxes. But there's also advantages to renting, right? Much lower upfront cost, a lot more mobility, lower maintenance responsibilities, and usually lower month over month costs as well. So when thinking about affordability, the first thing that we have to think about is how much home can the client actually afford in consideration of their other goals. I'll say that over and over again when we talk about affordability. It's not can the client make the payment, it's does purchasing the asset in question compromise the client's ability in any way, form, or fashion to make progress towards their other goals? And even if they can make the payment, the answer to the question is if other goals are compromised, then the client cannot afford that price tag. And so we have to think about the cost of buying the house over the long term. But in the short term, what front end monies are required and how does the purchase affect our ratios, right? We'll look at affordability ratios to make sure that we're making good decisions on the front side. And then over the long term, how are our ratios affected by the debt that we've created and the ongoing expenses associated with that debt? Now, we're looking at front end cost. Obviously, the down payment is a big one. Now, conventional loans say that we have to make a minimum down payment of 5%. Conventional advice says that we should be making down payments of at least 20%. And so even in that situation, we have to think about, does it make more sense for the client to make a low down payment or a high down payment? Well, the first consideration is how much resource does the client have available? And if the client has a lot of resource and can really choose between low or high down payment, the next question is, what is the best use of the money that would be making the down payment? Is there something that offers a bigger return on investment that if we use the money outside of making a down payment on a property, we could produce more benefit? If that's the case, then we might be a little bit lower on the down payment. But if the client needs to be debt free and is pursuing maybe retirement and not having a mortgage is extremely beneficial, then they might be looking at making a higher down payment for more financial flexibility, both in the short term and in the long term. Other things that come up front are closing costs and prepaids. We'll look at those more in here in just a second, and discount points. Okay, we'll talk about discount points and we'll look at a break-even analysis on discount points as well. All right, so if a client makes less than a 20% down payment, the lender usually is going to require a product called private mortgage insurance. Okay, so private mortgage insurance is set up to protect the lender in the event that the borrower defaults. Okay, so you're paying for an insurance policy for the lender if you have less than 20% down payment. This is why this is the conventional advice to make at least a 20% down payment so you can avoid this cost. Rates on private mortgage insurance depend on credit worthiness, right? And the last I kind of looked, the rates on private mortgage insurance on conventional loans, the most popular type of mortgage, range from about 0.5% to about 1.3%. Okay, so that doesn't seem like a big swing, but on expensive homes, that could make a big difference on the monthly payment based on the creditworthiness again of the individual or household that takes out the private mortgage insurance when the down payment is less than 20%. Okay. Now, points are a way to offset interest rates. Okay, and points are a one-time fee charged by a lender which increase the effective rate of interest at the time of purchase, but it ends up lowering the interest on the loan over time. And so when we're looking at points, 1 point, the cost of that equals 1% of the loan amount. Okay, 1 point cost 1% of the loan amount. And so points are just prepaid interest. A point does not actually buy down the interest rate. One of the most common misconceptions about points is if we buy 1 point, then I can take my interest rate from 6% to 5%. If I buy 2 points, I can take my interest rate from 6% to 4%. That is not how that works. If we buy 1 point, then we're paying 1% of the loan amount in the form of prepaid interest. And so by prepaying interest that would be due later in the loan, then we are in effect reducing the interest rate that's going to be charged over the remainder of that loan. Okay. And so let's look at a break-even analysis on points. If there's a $300,000 house with a 20% down payment, 20% on 300,000 would be $60,000. Okay. And the interest rate on this purchase is 6% over 30 years, no points. If we did the time value of money calculation on this, we would get a payment of $1,439 per month for principal and interest. Or by prepaying $4,800 of interest by purchasing 2 points. So how did we get to 4,800? Remember that the loan amount was $240,000. 300 minus 20% down payment equals a loan of $240,000. Each point cost 1% of the loan amount. So 2% of the loan amount is 4,800. Okay, so that's the cost of 2 points. Well, by prepaying that interest, the interest rate effectively goes down to 5.5%. Don't worry about the math on that. This is just an example. If the interest rate is 5.5% over the remainder of the loan, then the payment becomes $1,363 per month. And so we've got to look at the break even on this. How many months does it take to recoup the cost of the points? And so I can take the point cost and divide it by the payment savings. Okay. And so if we take the point cost divided by the payment savings, it tells us it's going to take 63 months to recoup the money on the purchase of points. And so as long as the client plans to live in that house for 5 years, this was a good deal. If this is going to be a 2 to 3 year starter home, then purchasing the points probably wouldn't be worth it because the client wouldn't be in the house long enough to recoup the cost. Now, switching gears and talking about closing costs and prepaids a little bit, here are some very common forms of closing costs. Okay, so there's always a loan origination fee, somewhere in the ballpark of 1% of the loan amount. Title insurance is required to be paid by the buyer. You can ask the seller to pay title insurance, but it usually falls to the buyer. And title insurance can be as little as $1,500 and as expensive as $5,000. It usually depends on the value of the home and any restrictions or covenants that are associated with that property. If there's a less than 20% down payment, then you do have to pay a portion of private mortgage insurance up front. And then the survey, really mapping the property lines of the home, is an upfront cost. And then any attorney's fees and other fees associated with the purchase. And then a big portion of closing cost is prepaids. So you have to pay at least the rest of the year's taxes plus 2 months. So depending on when the home is purchased, prepaids can really vary a lot. Same thing for homeowners insurance. You have to pay 1 year's worth of homeowners insurance premiums plus 2 months on the front side. And so prepaids add significantly to the upfront monies required at the time of purchase. The biggest cost, prepaids, title insurance are usually the biggest. Other things that aren't included here would be things like an inspection fee, maybe a home warranty that you're purchasing when purchasing the home, and other things like that might add to these upfront costs. In addition to upfront costs, we also have ongoing expenses. So the monthly payment is generally made up of PITI, principal, interest, taxes, and insurance. That is the ongoing requirement over the course of the mortgage. Taxes and insurance get paid into what's called an escrow account. An escrow account is just a holding account that the lender sets up on the buyer's behalf so that they don't have to worry about paying taxes and interest themselves. The lender collects that money, and then when the taxes on the property and the property insurance come due, then the lending institution makes those payments out of the escrow account on the homeowner's behalf. And so it's just a simplifying process, and it makes it a little bit more convenient for the buyer. In addition to property tax, or I'm sorry, PITI, there's also ongoing maintenance and operating costs. And so these can become quite expensive over time as well. They depend on the age of the home, the climate that the home is located in, and all kinds of fun stuff like that. So we definitely wouldn't want to overlook these things when making a purchase decision because they can be substantial cash requirements over the ownership period. Now, when we're looking at borrowing limits, most borrowers use a debt to income ratio of no more than 45%. Okay, so they'll say that we will lend you on a mortgage all the way up to the threshold of 45% on total debts to income. And so for clients that have a lot of pre-existing debts, that's going to reduce what's available to borrow in the form of a mortgage. For clients that are essentially debt-free outside of a mortgage, then obviously they're going to have a lot more capacity to borrow for a mortgage. Now, 45% is not what we use as financial planners when looking at this ratio, right? We have a front-end ratio of 28% that says the mortgage should not exceed 28% of gross income. And then we have a back-end ratio of 36%, right? This is basically the back-end ratio, the debt to income ratio. Well, the lender's saying we'll use 45%, but financial planners are setting a threshold at 36%. And so this might create an issue where a client gets pre-qualified for a mortgage and uses that pre-qualification as an endorsement for affordability. Like I was looking at $1 million home, but the bank said that they would lend me $1.4 million. So I guess that's what I can afford. No. Go back to affordability, right? We can only afford a payment on a debt if that payment doesn't compromise our ability to pursue our other goals according to their timeline. Okay, so 45 is a little bit high, but we need to know that there's a difference in the benchmark that financial planners use and the benchmark that a lending institution might use when determining mortgage availability. It's also kind of important to understand what the lender looks at as income, right? So obviously wages, but also overtime and bonuses as long as they've been received for 2 years. Social Security income, if that's part of the client's portfolio, self-employment income, if it's part of the portfolio, commissions, alimony, and then other forms of passive income would also be considered. So really important to recognize that, because you can help a client understand what their mortgage availability might be on the front side by doing some rough calculations before even going to a lender. So there are a lot of ways to pay for a house, right? The most common way is to use some portion of cash as a down payment and to fund the remainder of the purchase price with a mortgage. But there are other ways, right? We could pay cash outright. There might be seller financing options. And then there are 1,000 different types of mortgage products that exist on the market. It's important to know the basics of the most common types of mortgages, but you don't have to be a mortgage expert, right? Financial planners oftentimes work with mortgage lenders who are experts on the market and the evolution of products and how they apply to different financial situations. And financial planners lean on those people as partners to make good lending recommendations when dealing with clients that are looking at making home purchases. But fixed rate mortgages are by far and away the most popular. Fixed rate mortgages are exactly what they sound like they are. They're a mortgage that have a fixed interest rate and in turn a fixed payment over the entire life of the loan. Adjustable rate mortgages are exactly what they sound like they are as well. Adjustable rate mortgages usually have a fixed teaser rate on the front side of the mortgage. That teaser rate may be a rate that applies to the first 1 to 2 years of the mortgage. It's usually lower than the rate on a fixed rate mortgage, but then after that teaser period expires, then the interest rate on the mortgage is tied to larger interest rates that are at play, right? The prime rate, the Fed funds rate, all those things as they move up and down in the marketplace will impact the interest rate on the mortgage and in turn, the payment on the mortgage as well. So there are circumstances when adjustable rate mortgages may make a lot of sense. When interest rates were 7% in the most recent market, but you could get an adjustable rate mortgage at 6.5%. A lot of people were saying, hey, listen, I'll take the lower upfront rate and bet on interest rates going down. If interest rates stay the same or start to trickle down after the teaser rate period expires, then the borrower wins. If interest rates take a big plunge down, if the adjustable rate mortgage borrower thinks it makes sense, then they can completely refinance out of the adjustable rate mortgage into a fixed rate mortgage and lock in that low rate. So I just used a new term, refinance. Refinance is a very simple concept. It is just replacing an old loan with a new loan, and then the characteristics of the new loan take over. So we just talked about this. Refinancing makes sense under a lot of different circumstances, but it's going to be dependent on a client's goal. We may want to refinance to get a lower interest rate and in turn a lower payment. We may want to refinance to take equity out of the home and use that cash for some other goal. There are a number of things that may drive a refinancing decision. Anytime we refinance, an appraisal is going to be extremely important. The law in the state of Texas says that on a refinance where there's going to be a cash out element associated with the refinance, so a cash out refi, or even a home equity loan, the state of Texas says that the total amount borrowed cannot exceed 80% of the value of the home. Okay, so there has to be at least 20% equity in the home after the refinance takes place. So in determining equity, we have to determine value. And so the appraisal becomes very, very important. Okay. And you also have to qualify for a refinance as well. And so, depending on financial circumstances, if the credit worthiness of the client is better than it was when the original loan was taken, then obviously the terms are going to be more optimal. If the client's financial situation and credit worthiness are potentially worse than they were when the original loan was taken out, then the opposite could potentially be true. Now, does it make sense to accelerate mortgage payments? Again, this is dependent on the client and the client's goals. Accelerating mortgage payments, the biggest benefit is reducing the overall interest cost associated with the debt and shortening the timeline on payment commitments, right? If we pay it off early, the debt goes away, which means that the payment associated with the debt also goes away, and it creates some financial flexibility. But there's a trade-off, right? If we're going to accelerate mortgage payments by making larger down payments or larger payments over the life of the loan, then we're going to be restricting cash flow that's available for other things, right? And so ultimately, we're almost saying that the long-term benefit of paying the mortgage off earlier is greater than the long-term benefit of taking the additional payments and applying them to something else. Okay. And so we always have to consider that trade-off. It's not necessarily always good just to pay the mortgage off early. We have to say, what is the alternative, right? Could I use the cash that would be used to pay the mortgage off early and apply it to something else that potentially produces a bigger benefit over the course of the planning horizon? And if so, then we really need to consider the two against one another. All right, there's an example. You can look at that and make an analysis on that. Now, home equity loans usually have a fixed rate, while lines of credit typically have an adjustable rate. And so when you're looking at these two things and saying, what's the difference between just taking out a home equity loan where they say, here you go, you borrowed the money, we put it in your account, use it for whatever you want to, but you have to start repaying that loan as soon as we fund it. Versus a line of credit that says, hey, listen, here is access to a line of money, but we're not going to give it to you until you request it from us. Okay. So that's a big difference between a loan and a line of credit. And then home equity loans, usually fixed rates. Home equity lines of credit, usually adjustable rates. And like we said already, the state of Texas has an 80% loan to equity limit when taking out loans and lines of credit. Now, when taking out these products, there are usually fees on the front side, and then there will be interest charges for whatever the debt balance is moving forward. There's also tax advantages, though. We can deduct the interest as mortgage interest when itemizing deductions, but we are double securing the property. So if we have a client that either fails to pay their mortgage or pay on their home equity product, the home securing that debt is at risk. And so we have to make sure that we are aware of the double security issue that equity products create. And so let's look at an example of how much home equity could be taken out, either in the form of a home equity loan, line of credit, or a cash out refinance. So let's say that a client has a home with $150,000 market value. Well, Texas says that the total debts on that value cannot exceed 80%. And so we'll multiply the 150 times 80% to say the total loan limit is $120,000. If the client currently has an outstanding mortgage of $80,000, we'll take that out of what's available and say the maximum loan that's available through home equity would be $40,000 in this case. Here's another example. Your Texas clients own a home valued at $350,000 and have an outstanding loan of $100,000. What is the maximum amount of home equity they can take from that property? Okay, so we'll take again the 350 times 0.8. That gets us a total loan value of $280,000. We'll subtract out the mortgage that currently exists of $100,000, and they could borrow up to $180,000 on their home equity. Now, the last thing we want to talk about are reverse mortgages. Okay. Reverse mortgages are the exact opposite of a traditional mortgage. In a traditional mortgage, an individual pays the mortgage company on that debt product until it's paid off in full. And once that takes place, they have 100% equity in the home. Okay. Well, in a reverse mortgage, the bank says, let's look at the equity in the home. What's it worth? And the bank essentially buys that home back from the homeowner. So let's say that we have a homeowner that has a home that's worth $500,000. The bank assesses that and they say, hey, listen, you're in retirement, right? Over the age of 62. And if you want to access the home equity without selling your home, right? You want to stay in the home that you're currently in, but you need the money out of the home, then we'll pay you a monthly payment to essentially buy that home back from you. And then over the course of the life expectancy of that client, they reaccumulate a debt on that property equal to whatever the bank paid them back. Okay, so let's say that the client passes away 20 years later and the bank paid them the full $500,000 back. So when they pass away, the home passes to their heirs, and the heirs have now the home value minus the debt that was created through the reverse mortgage payments. Okay, so if the home value is now $600,000, but the bank paid out $500,000 in reverse mortgage payments, if the heir decided to sell that house for $600,000, they would first pay off the reverse mortgage debt of $500,000, and then they would keep the $100,000 in equity that exists. To qualify for a reverse mortgage, though, it has to be the primary residence. The homeowner has to be at least 62 years old and continue to live in the home over the term of the reverse mortgage. Okay. And then you don't repay the debt created by the reverse mortgage until death. Usually the heir sells the home and the debt is paid, and the heir keeps any additional equity that existed in that property. I think these are going to be a really popular product for retirement income moving forward. Their popularity is increasing continually over time. And so I think you'll definitely see these in financial planning engagements as you enter the industry. All right, that concludes Unit 4. We will be looking at all these topics for the quiz. I'll be posting a review for that so that you can ultimately be successful. If you have any question over any of these topics, though, you know you can reach out to me anytime, and I'll be happy to help.